Traders Corner is brought to you by IG.
Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, hopefully it'll be a long time before we discuss US elections again, but it is going to be the theme of this week's show and all shows that we're holding on Business Day TV. But it has been positive for markets, and markets certainly seem to be betting on a Clinton presidency.
Yes, that's right. At the moment, that does seem to be the case. It's all come about since the weekend when Hillary Clinton was sort of essentially cleared of any criminal wrongdoing in her email scandal. And the markets have taken that as good news in the sense that it, I suppose, boosts her election campaign. And it looks as if the odds are now betting on a Hillary Clinton win. But having said that, it is still quite a close race. It's not a done deal. And I mean, I'm obviously very much reminded of Brexit a couple of months back where it didn't look like it was going to happen, and then it did happen. So I think whilst the markets are telling us it looks like a Hillary Clinton win is priced in, I think let's just wait and see. But I mean, I wouldn't bet against that, put it this way.
Yeah, look, I think a lot of people had their fingers burnt by Brexit, so no one really wants to make any gross calls at this stage. But going to the S&P 500, because last week we were discussing how the market was making these lower highs and it looked as if it was going to break to the downside. And then you said, well, there might be a little bit of a rally if it does kind of break and then bounce off that support level. And that's exactly what's happened. So with your powers of prognostication, can you tell us what's going to happen next?
Well, if only I knew. But here's the chart of the S&P 500, and it's the same chart we've looked at many, many times over the last number of weeks. And you can see what I've been going on about the whole time is the fact that the market has been testing this lateral support at 2120, and every time it bounces, it makes a lower high. So that's been telling me that the higher probability here was that it was eventually going to break that 2120 support. And I said last week on the show that it was looking vulnerable, and that if it did break 2120, we would probably see it moving down to the 200-day moving average quite quickly. And you can see that's exactly what has happened. It broke below that lateral support, and then it went to the 200-day moving average, basically gave it a little kiss, and then rallied on Monday. And you can see it was a big rally on Monday. It was 2.5% up odd on the day. And that all came about following the weekend press reports that Hillary Clinton effectively is not going to she's not subject to criminal investigation because of her email scandal. So the markets see this as good news. The markets like the possibility of a Hillary Clinton victory because I suppose there's a bit more certainty in that, whereas Donald Trump is a bit of an unknown, a bit of a maverick, and markets don't like uncertainty. So if you believe what the markets are telling you, then the markets are telling us that Hillary Clinton's got it.
I suppose the question now, though, is how much more could markets rally if she does get elected president of the United States?
Yeah, that's the big question, and it's going to be very interesting to see. I mean, I suppose from here on out, from a technical perspective, we need to see whether this S&P 500 is able to then break above 2160, which would effectively mean a break above that downward trend of the last 3 months or so. And that could then be a bullish break that might push the market back up to prior highs or even new highs. But let's see. Let's see how things play out, because there's also a possibility that maybe the market's priced in this Hillary Clinton win, and then it's a buy the rumor, sell the fact kind of scenario. So it's difficult to say with any certainty right now how the market is going to react if she wins.
And if it's a Trump victory, do you think the market's going to fall in a heap?
Yeah, I think the market will suffer quite a big pullback if Trump does win. And you'll see volatility going absolutely through the roof. And that's actually my next chart. Is the VIX index. So the VIX index is a measure of volatility. Essentially, it measures implied volatility on S&P 500 options, and this is what options traders and writers use to price up options on the S&P 500. High volatility typically associated with a market that's fearful. Low volatility is associated with a market that's calm and generally complacent. Now, what's quite interesting over the last 2 weeks, or specifically over the last 9 days really, is notice this massive spike that we've seen in the VIX index. And that has come about because Donald Trump was closing in on Hillary Clinton over the last 2 weeks or so. And the market didn't like that, and hence why we saw the S&P 500 falling. We've seen the VIX spike, up 77% in 9 days. That's plenty of movement there. But then again, have a look what's just happened on Monday, yesterday. You can see the VIX gap down again sharply. went from a reading of 23 all the way down to a reading of 18. So it's a big sudden drop, and that also has then come about with the market making the assumption that Hillary Clinton is probably going to take the presidency.
I mean, on any other chart, would you say it looks likely that the VIX is going to subside further, or are all bets essentially off because it's binary, really?
Well, it's going to depend on how the election goes. Look, if Donald Trump does manage to win this election, that VIX chart will probably go right through the roof. But if Hillary Clinton wins, then I think you'll find the VIX will subside. And you'll notice the VIX never stays up for very long. So, volatility, that very volatile time in the market doesn't last long. It often runs out of energy quite quickly. So if you go back and look at the end of June here, that was Brexit. You can see the volatility, and then it just fizzled out very, very quickly. There was a little bit of a spike in early September, and it fizzled out quickly. So, this spike up in volatility now, I wouldn't expect it to hang around for long. Especially if Hillary Clinton does win, then I think you're going to see volatility come back down. I
mean, just a question before we move on to the other charts, and there are a few to discuss. You never trade the VIX, and it is possible to trade the VIX. Is there a reason why you don't trade it? Is it quite sort of technical and quite tricky to do? It
is. I've traded a little bit offshore in my personal capacity on the odd occasion. The thing is, it's a funny instrument to trade. You always want to generally be long of the VIX, especially if it's at a lower level. You want to try and get long of the VIX because there's always a potential for a spike. Something that I would consider doing is if Donald Trump were to win, which I don't think is going to happen, but if he were to win, you'll see the VIX will spike massively. I would probably then look to short VIX because it's not going to stay up for long. The VIX will then subside. So it can be done overseas. It can also be done locally, as far as I understand. I think there is an IDX future on the VIX, if I'm not wrong, but I stand corrected there. So those who wanting to trade VIX locally could potentially do it through that instrument. But otherwise, it's a lot easier to trade it on the offshore markets.
Yeah. Okay, and another index, which is to sometimes relative, it's an indicator of volatility or lack thereof, is the gold price, interestingly enough. And it did start ticking up. But now, where do you think the action is headed?
Yeah, it's interesting, the gold price. So I mean, we covered this a couple of weeks back, and I said at that stage, watch out, because it's been making falling tops, very much like what the S&P 500 was doing recently. Falling tops with this lateral support at $1,310 an ounce. Now you can see, I said all along I think it's going to break to the downside, and eventually it did. And we saw a very, very sharp move down to the 200-day moving average, and it's since been clawing its way back up. Now it rallied quite sharply last week with the possibility that Donald Trump was closing in on Hillary Clinton. And you can see that it pushed the gold price right up to this resistance line at 1,310. It has since failed at that resistance now, and it started to come back down. So my thinking here is that if Hillary Clinton wins, then the gold price is probably going to come back down again, and it might even retest these prior lows at about 1,250 and potentially a bit lower. On the other hand, if Donald Trump were to win, then the likelihood is that the US dollar will weaken significantly, and there'll be a chase for this sort of safe haven environment, which is obviously gold. So you get a weaker dollar and a chase for safe haven, and I think you're going to see this gold price push out through that resistance. So essentially, this is a good barometer of who's going to win the election, I suppose. If you above that resistance belongs to Donald Trump, below that resistance belongs to Hillary Clinton. And right now, the price is telling us Hillary Clinton's got it.
Wow, what a world we live in. What a time to be alive.
Absolutely.
What about our own market? Because it had kind of rolled over. And then, of course, we had a really good day yesterday in line with other markets. But do you think that was maybe just a temporary flip?
Well, let's see. I mean, there's still very much a pattern of lower highs forming on our top 40 over here. The 44,000 support level is what I'd spoken about on last week's show, and said that it was looking vulnerable to breaking to the downside. It did break to the downside. And I said, look, if it breaks there, there's a good possibility it goes down to 42,000. Now, I don't know whether that 42,000 is still feasible or not. It could be. I think it depends on what type of pattern the market forms from here. If it forms a weak bounce, or sort of like a dead cat bounce, and maybe make some kind of a continuation pattern here, like a bear flag or a rising wedge or something like that, then there's a possibility that it does have another leg to the downside. If not, and if it manages to break this downward trend with the arrows indicated over there, then maybe it's telling us that we've got a bit of a rally on our hands into the end of the year. It's difficult to say, but as I look at that chart right now, I still think it's not a great looking chart. It's below its 200-day moving average and below the 50-day moving average, and it's below a whole bunch of resistance points. So it's not a great-looking setup, but let's see.
Well, I suppose the great thing is that you have hedged yourself on either side of a correction or a rally. And you talk about last week's show. So to some extent, this show is quite repetitive because we are kind of discussing the same things, and we'll talk about that in a minute. But just a reminder of how the options that you've got on the portfolio stand to benefit from the market.
Yeah, so we've got a December put spread structure on, which effectively gives me bearish participation if the market were to fall. What I did, however, do is, because these options are in the money, I went long 50% exposure long against these options with some all-me futures. So it basically gives us this payoff that you can see with this green diagram on the right-hand side here. Anywhere down to 43,000, we make our maximum profit. But anywhere, if the market falls, we're going to make money. If the market rallies, we're also going to make some money. What I would be disappointed with is if it ends the quarter at 45,500, because that's where we make the least amount of money on this thing. But effectively, we've got a V-shaped payoff here. So whether the market falls or the market rallies, we're going to make some money on it. And I think in this current environment where we don't know what the market's likely to look like by the end of this week, that's probably not a bad way to be positioned at this point in time.
Yeah, and once again, I mean, and I'm sure viewers will forgive us for talking about this again, but one of the key factors in our market is the rand-dollar exchange rate. And the problem is it's at the mercy of what happens to the US dollar.
Very much so. And I know we did speak about this last week, and we're rehashing a lot of charts this week, but it's also an update because some of the stuff the technical breaks that I was looking for last week have now happened. And last week we spoke about this rand-dollar exchange rate, and at that point I was saying, watch, it looks as if the rand might break below 13 rand 50, and if it does, that would validate this bullish rand, bearish dollar triangle pattern. And you can see quite clearly 5 waves indicated in that triangle structure over there. It's breaking below 13 rand 50 now, and theoretically that probably can take us down to 13 rand and probably even further down to 12.50 or even 12. So if that is to be believed and the rand does go stronger, then that's likely to weigh on our market. But obviously it's also subject to political noise and the US dollar, so there's a lot of external catalysts that could mix things up here.
And maybe on that note, Garth, critics of the show might say you haven't. It's been very sluggish trading this year, and you haven't taken too many positions in the market. And for example, the last few weeks we've got an option structure on, but not much has been happening. But do you think it's maybe experience that sort of makes you take a backseat at this point because you really don't know what's going to happen? Or are you just being overly cautious?
I probably am being overly cautious. But also, we've got, if we look here, the portfolio has done well for the year to date. We're up 22% for the year to date. And I suppose, yes, I am maybe just winding down the clock a little bit here, to use a rugby terminology, waiting for the final whistle to blow. Because we've only got a couple of weeks left of the year, really, and of this show, before we then donate the profits that we've made to charity. And we've made nearly 55,000 Rand profit for the year to date. It's been an incredibly difficult year. So I think we've done very well to achieve this kind of performance. And yes, I am probably just sitting on it and saying, well, it's been okay, let's not mess it up into the end of the year. We've got this option structure with the all-me futures, and it gives us payoff any way the market goes. It's not such a bad place to be in such an uncertain environment.
Yeah. I mean, I suppose the worst thing that we could do now is just blow out the profit that we've made and see our donations to charity evaporate. So we really don't want that to happen. But Garth, so we'll leave it there. As you said, 22% up for the year. It's really not a bad performance in the light of what's happened. And then just to end off with, you do have a couple of courses still coming up.
Yes, we've got courses still now in November, a couple of courses. This weekend, the 12th of November, my colleague Andrew Todd runs a Top 40 trading course, and I'm running a high probability trading course in Joburg on the 19th of November and in Cape Town on the 26th of November. So anyone that would like to attend any of these courses, please email me at garth@traderscorner.co.za and I'll send you all the details.
Okay, great. And of course, if you'd like a weekly email reminder, you can go into the website.
Correct. Go to traderscorner.co.za and you'll see that there's a link to a free weekly email in the middle of the page, and there you can sign up for a weekly email that will detail what's coming up on the TV show each week. I'll give you a little bit of a heads up, and it's free to subscribe to that emailing list.
Okay, Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.
Traders Corner is brought to you by IG.